Recently, I was a speaker at a conference where I gave a presentation about passively investing in industrial real estate, and I thought I'd share the slides in the presentation with you as well. So generally speaking, passively investing in real estate is when there's a sponsor of the deal, which is often just called the general partner, and then there's limited partners or LPs, and those are the passive investors that aren't involved in the day-to-day operations and management of the property. So I'll put links in the description if you want to look more into the mechanics and how these deals are structured. But assuming you have some familiarity with GPLP structures, I'll go through my presentation specifically about some of the things that I look for myself when I'm considering investing, and also what some of the areas of risk are and things that you want to avoid. So pull up the presentation here, and I hired someone to do it, and I said for the template, it'd be great if you could have something to do with industrial real estate. And they came back with this interesting architectural design. Looks more kind of like a city to me, but I think that there's some industrial in there if you look closely enough. So I'm just going to go with it. So about myself, so I actively invest in properties myself, and I'm also a limited partner as well in 2 different industrial properties. So I'm coming at this from an area where I've worked in the industrial real estate space for the last 18 years. I'm an investor myself in actual assets, and I'm a limited partner as well. So I do have experience talking about this, and I just love industrial real estate. If you've seen any of my other videos, I absolutely love talking about this topic. So I'll go through some of this a little bit quicker than I did in the actual presentation, which was about half an hour, because I have a lot of videos on this topic. But real quick, the agenda that I had: what is industrial real estate, why industrial real estate, what to watch for, and the risks. And I ended with some questions which were interesting as well. So first thing, what is industrial real estate? I've talked about this ad nauseum on my channel. I usually break industrial real estate into 3 subcategories: warehousing, manufacturing, and flex. Warehousing are things where products are stored for some period of time. This is a very broad generalization because you could even dive deeper into this and talk about distribution centers or fulfillment centers. But generally speaking, at a broad level anyways, warehousing are where things are stored. And you can think of an Amazon facility where trucks come in, they bring in the product, it gets stored for some period of time. It might be minutes, it might be several months. Those things are stored and then they're shipped out. Manufacturing is generally where things are made. So the example I love to give is the Boeing factory just outside of Seattle, where all the raw materials will come in, the workers will assemble, manufacture, produce, put together everything for that airplane, and then the finished product, in this case an airplane, gets sent out. Manufacturing is as big of an industry as the warehousing industry. It just typically tends to work outside of the public purview. You'll generally see a lot of these manufacturing properties tucked away in industrial parks. So unless you have familiarity with going through these buildings, they're by design. The municipalities will often zone industrial properties to be out of the public purview. So it's still a massive part of the business, but it's just not as common as seeing a big Amazon fulfillment center right outside of an airport, maybe perhaps on a major road. And the third one in that category is flex industrial. Generally, these are all the properties that are zoned industrial but aren't used for traditional manufacturing and warehousing. And one property that I own myself is a flex industrial property. It's zoned industrial. It's in an industrial park, but we have a number of different tenants in there. There's one tenant that's straight office use. There's another cabinet store. We have a hot tub store in there, which has their retail and some showroom space and then a little bit of storage. So it's an industrial building. It's just not used for manufacturing or warehousing. And I think it's important to know exactly what you're investing in there, because a warehouse isn't necessarily compatible for a manufacturing use and vice versa. And a flex property might not be compatible for either of those. So I think having a really good understanding of what industrial real estate is the first step in deciding if industrial real estate is something that you want to consider. And just real quick, I included some pictures just for people that wanted to visualize what these are, this is a warehouse, a number of dock loading doors across the whole building. And again, you can just imagine a whole bunch of trucks backing up, loading, unloading product to be, again, stored for some period of time. And this is what it could look like inside. Here's the Boeing factory that I mentioned. I had a chance to go by this in person, and it is huge. 4 million square foot building, 90-foot tall ceilings. So from a volume or cubic footage standpoint, it's actually the largest building in the world, and it is enormous. Manufacturing, this would be a heavy manufacturing. You could also have manufacturing that's computer chips or very clean manufacturing. But again, anything where things are made, assembled, manufactured, that would be a manufacturing property. Here's the one property that I mentioned that I own with 3 other partners. It's a flex industrial space. We did a big renovation on it recently, a full exterior renovation, and now it looks almost more of like a retail building, but this is an industrial zone building in an industrial park. So one of the reasons that I really like industrial, and I won't just sugarcoat this, because while I have the majority of my own net worth directly invested in industrial real estate, I don't think it is for everybody. But there are reasons why I'm so attracted to it and why I think it is compelling and perhaps something that you want to consider. I also have some reasons on why you might not want to consider industrial as well, just to tell the full story. And I'll get to that in a second here. So one of the main reasons is that you lease to corporations, as opposed to residential or multifamily where you're renting to families or individuals, and you're beholden to all the residential tenancy laws and eviction moratoriums and rent control and everything that just goes with renting to individuals or families. In industrial, for the most part, you just follow contract law and you're leasing to corporations. So with that, you also get to see their financial statements. You get to see if they have retained earnings, what their revenue are, what the revenue is, if they've had a history of paying rent. You could see that all in their financial statements. So I like the idea of leasing to corporations more than leasing to families. That's just my own personal preference. Another benefit is there's long-term leases. And for industrial, it's not uncommon to see a 5, 10, 15-year lease. And one property that we have in our portfolio is a single tenant building leased to a Fortune 1000 company, and it's on a long-term lease. And by comparison, if we're to have the same value of a property in multifamily, we'd likely be dealing with 15 tenants that would be at risk of rolling over every year, perhaps every 2 years. We have one single tenant who's a very strong corporation on for a long-term lease. And tied into that is a triple net basis. A lot of industrial leases, and you want to check what the lease actually says. I don't want to claim that every lease is structured this way, but it's common. And personally, every property that I have is a triple net lease. That's where the tenant pays base rent or net rent, and then they also pay for the proportionate cost of operating that building. So generally, I'm saying generally a lot. I should almost have had a drinking game on how many times I've said generally. It will refer to property taxes, building insurance, common area maintenance, landscaping, snow removal as an example, and property management. So the tenant will pay some predetermined amount of rent in their base rent, plus they'll pay for all the proportionate costs of operating that building. And that also means that if those costs increase, if property taxes go up 10%, as an example, those costs will flow through to the tenant. If it's a single tenant building, they'll just incur all of it. If there's 2 tenants in the building, they each operate 50%, they will incur 50% of that increase in those costs. So that really helps prevent the base rent or the net rent or even the profit, is how you could look at it, from being eroded. And it ensures that you're not having to pay those costs that rise. So that's one of the biggest reasons that I think industrial is so compelling, and commercial as a whole. And then also tied into that, there's less management involved. Going back to that single tenant building that I mentioned, you could appreciate that managing one single tenant that's a large corporation is a lot less time intensive than managing 15 residential tenants, all which have their own needs, all which have issues that seemingly happen at the worst possible times. a lot of industrial companies are business hours, and they'll tend to take care of a lot of small things themselves. So it's a lot easier to manage those properties, and then also to scale. If you wanted to grow a large portfolio of properties, it would become very time and management intensive to scale a large multifamily portfolio without developing some very sophisticated systems and some in-house management, where conversely, you can grow a larger industrial portfolio without having to have nearly as much internal infrastructure. So those are the main reasons on why I like it. Other people might have other things to look for, but those are the ones that I like it. So here's what I'd recommend if you are looking to be a passive investor and you want to look into a potential deal. And again, this is coming from my own experience on owning real estate myself, as well as being an LP. Here's what I would look for if I was being an LP in another project: is you have to get an understanding of what their experience and track record is. And to do that, simply ask what other properties the GP has been involved in, and ensure that it's industrial specific. And I'll talk about this in risks in a second on why this is so important. But if the GP doesn't have a considerable amount of experience, they're not going to be able to navigate some of these risks, and it could result in a pretty bad situation. So where I mentioned that industrial real estate has a lot of advantages, there are also a lot of disadvantages. And to mitigate those disadvantages and that risk in general, you need to have a GP, or at least I would want to have a GP that has a lot of experience in this space. It don't necessarily need to have that they have their own skin in the game, although that's definitely a good indicator that they're confident on the project. Instead of having their own skin in the game, I would want to see what their track record is and what their experience is. That's how I would personally invest in it. And then when you're looking through the deal, look into what assumptions are being made. Is it a value add play? Is it a stabilized asset where there's cash flow already baked in, and perhaps it's a long-term lease with a single tenant? Or is there upcoming vacancy? And always, I can't emphasize this enough, is always look at the downside risks before looking at any of the forward-looking projections. It's very tempting and compelling and appealing when you look at a pro forma that extrapolates the deal out over 10 or 15 years, and it shows all these great numbers about how high the internal rate of return will be or what the cash on cash will be. And it looks very compelling. But before you go through that motion, and this is how I look at it myself, is look to see what the downside risks are first. I am a downside risk first investor, where I want to fully understand what my maximum exposure is before I start looking at how sexy these numbers can look. So that'd be my general advice, is you really need to understand what industrial real estate is yourself. I wouldn't go into a property, and I wouldn't recommend people go into a property, even as a passive investor, unless you have a basic understanding of what you're putting your money behind. Because at the root of that investment is an industrial property, or perhaps a series of industrial properties, but that is the asset. So you're relying heavily on the GP to give you some comfort on that and to navigate it through. But I think it's imperative that all investors at least have a general understanding of what industrial real estate is and be aware of the risks, because industrial real estate can be great, but it can also come with a lot of risks. So here's the three that I mentioned that I would be most aware of, most cognizant of, is that a mistake in industrial can be greatly magnified. And real quick story, an investor that I know bought a property in a small market outside of a major market. So the city itself was large, but this was a smaller market, half an hour outside of the major city. And they bought the property. There was 4 years left on the lease, and it was a large construction company that was leasing the property. After 2 years of owning the building, the tenant said to them that they were vacating the building and they would still honor their lease obligations. They still had a lease, they still had to pay it, but they had no longer a use for that building. So they vacated the building, but continued to pay rent on it. They were trying to sublease the space in the interim so they could mitigate their costs, and it never did sublease. So the property has now become vacant. There is no tenant in there. They've been marketing it for 2+ years. property is now vacant. There's no revenue coming in. So now they have all the expenses of property taxes and insurance. But to make it even worse, a provision of their insurance is that they have to physically check on the property every 2 days to make sure that there's no floods or damage or break-ins. So one of the partners, and I believe there's 2 or 3 partners, has to drive to that building every 2 days to do a check on that building. And because it's 30 minutes out of the city, it's probably a 45-minute drive from their house to that building. So an hour and a half round trip every 2 days to go to a property that's probably lost 25% of its value. So that's an example of, if you don't fully understand exactly what you're buying, then you could be at risk of losing money and time. And a way that could have been mitigated is, and it goes back to check your downside risk first. A personal philosophy of mine in investing in anything is I want to go through the analysis of what that property would be worth if it were vacant. So even if there's a tenant in there for 10 years, even if there's a tenant in there for 20 years, properties will all eventually come vacant. The lease might expire. The company might just decide that they don't want to lease it anymore. The company might go bankrupt, which happens from time to time. If you go through the exercise of determining what that property was worth if it was vacant, then at least you know, if we had to release the space, it would be worth this amount. If we had to sell it, it'd be worth this amount. And going through that exercise, had this investor went through that exercise, he would have determined that the lease rate for this property is much less than what that construction company was paying. And that should have been factored into their equation, as opposed to saying, we get a great return for 4 years. We hope that they renew. That's looking at it through the rose-colored glasses approach, as opposed to saying, what is my downside risk on this? So that's an example of a mistake, which is somewhat unique to industrial real estate. In multifamily, you're not going to have that same issue. If you buy a well-located multifamily property and you're competitive with rental rates in the area, you're probably always going to be at the market occupancy rate without as much risk or exposure. But industrial real estate, an example like this, that can be a net worth draining property. Next, leasing to a new tenant can be very expensive. And if going back to comparing it to multifamily, if it's a multifamily unit that comes vacant, it's probably just cosmetic work that you need to do for the next tenant. Whereas in industrial, especially for some of the properties that were custom made, tailored for the previous tenant, it can be very expensive to retrofit that for the next tenant coming in. I've had tenants roll over where I've only had to do basic cosmetic work as well, and it's still more expensive just because you're dealing with higher ceiling heights and the spaces are larger, but the cosmetic can still be somewhat expensive. But if you have to retrofit, start getting into structural or foundation issues, start getting into capital expenditures beyond just the traditional stuff, it can become very expensive. And again, that goes back to just understanding what your downside risk is. What is this property in its current form? And if it did come available, what costs am I going to have to incur to get that back to a level where it's competitive with the rest of the market? So just reinforcing, look at your downside risk in industrial, and it'd be very hard to know that if you don't have some background in industrial real estate already. So in my mind, a prudent passive investor needs to put a lot of faith in the GP. That's why it's so important to scrutinize their experience and what they've done. But I also think it's important that you have a general understanding of it as well, just so you get a bigger picture of what your potential risk would be. And you might catch something that the other people aren't seeing, and either you pass on the opportunity or you pass on that information. But having another set of eyes on an asset class like industrial, where there is the potential for mistakes, is never a bad thing. Last is environmental risk management. If you have a tenant in there that's not adhering to proper procedures for dealing with any potential contamination, and the property does become contaminated, that can be a very big issue. There's a lot of systems in place to mitigate that risk, whether it's insurance, environmental insurance, or whether it's just having very good language in the lease to surround that. just be aware that if that isn't addressed, that could be a big concern, because remediating an environmental contamination can also be prohibitively expensive. So with all the risks out of the way, let's move on to, I guess I just went to questions on that. So one thing that I would also highly recommend is don't just look at the slide deck that an investor is presenting you with. Dig into it deeper, and ideally even go through the property. And that will help give you a much better understanding of anything that could be an issue. Low ceilings, as an example. If I did a video not too long ago talking about a property that had 14-foot ceilings and how it ended up costing that developer over $1 million. Those things might not show up in the slide deck. So going through the property, or at the very least seeing a number of pictures or a video walkthrough, anything to help familiarize yourself with that property, I think would be really important. And keep an eye on what your downside risk is first. Again, I am a big passionate believer in industrial real estate. I'm bullish on this. I think industrial real estate's got a long runway, and we're not going to be prone to the same risks and challenges as other asset classes, but there are different risks and challenges. So as long as you can alleviate some of those and identify what your downside risk is, I think you're in a much better chance for a successful outcome. And the last thing that I would end on is don't be afraid. In fact, actively go out and get other opinions on this as well. So at the very least, I would have your lawyer commenting on this. I would have your accountant commenting on any prospectus that you're presented with. If you have a broker that you know in the area that's familiar with the local market, to get their opinion on it would be very helpful. I would close, I guess, by saying this. You're a passive investor if you're an LP, technically, but you still want to be actively involved in going through the process of determining if it's the right property for you. And that just involves analyzing who the GP is, seeing what your downside risk is by understanding what industrial real estate is, some of the pros, some of the cons, some of the limitations of it, and then getting expert opinions. And a saying that I use all the time is you just want to make the best decision you can with all the information you have available. And that is an active process. So do that active work up front, and then sit back and hope that your passive investment does what you expect it to do. Thanks for watching this video. Hope it was helpful. If you have any questions or comments, please leave it below, and I'll try to reply to everything I can. Thanks for watching. Have a great day.